All right, guys. Good morning. Good morning. So, I'll be talking about the pullback, just the pullback, just as an fortune God requested. So, I'll be talking about the pullback in general, the pullback cycle, the principles, the time frames that are involved in it, and the rules. So, first of all, I actually do not trade with ICT. I make use of my own trading system. I make use of my own trading system. So, there are going to be some blend of words in the sense that I might actually want to use of ICT terms so that you all can understand me. But what I mostly use is my own trading system. It's a trend trading system and not ICT. And everything are all the same. Every market are all the same. You just have to understand. You just have to understand the strategy or the system you are using and see market in that way and translate it to other systems. So that is it. So about the pullback, we all know pullback. Pullback can sometimes be called retracement. You can call it a pullback, you can call it a retracement. Now, this is what I mean by a pullback. When price trend up and drop back down. Now, ICT, those of us using ICT, we might call here an external liquidity. This I here an external liquidity. Then price retraces down to any internal liquidity area here. And from there, we have a pushback up. Break the external liquidity, form another external liquidity, then the pullback. Now, this pullback is all I want to talk about. This pullback, this move here, from here to this point, is all I want to actually talk about. And so, we'll talk about the pullback cycle. Now, the pullback cycle will start from the key level area. Now, the key level area are those areas where markets find support or resistance level. And after that point, the next thing the market will do is to form a range. Now, a range in the sense that the first two bars, the first trend bar and the next opposition bar forms a range in the sense that when the market is going, let me take this quote. In the sense that when the market is trending down and it gets to a support region, now that particular bar that rejects, that price rejected to form the support, the particular bearish bar, and that particular bullish bar, the bullish bar that formed after this particular bar becomes our range. Now, this is our range. The range, this is the range we are looking at. Now, it is a range because the market has not yet given us the validation that they want to do what? Retrace or pull back higher. And so the market can give us an A, B, C, up and down rectangular range and keep dropping. So that is why we want to call it a range. Now, this bar, these two bars, take note of these two bars, they actually form the range. Now, when they form the range, the next thing you want to see is this. Whenever a range is formed, you want to go down to the lower time frame. So I'm talking about number 3, lower time frame break in market structure. You want to go down to the lower time frame and look for what? Your break in the market structure. Remember, the market is coming down. We have our range from here to this point. You want to do what? You want to find a particular structure of A, B, and C. Just want to look for A, B, and C in that range. A, then the market goes up, break market structure, form the B, there's a change of character. And from there, we have C. And from C, you can actually make price come back down to this point or to any of these levels here, then go back up. Now, this particular formation you are seeing here, this ABC you are seeing in number 3, confirms that the market wants to what? Pull back, want to retrace. At this particular range, there is no break in market structure. So the market has not confirmed any pullback yet. No, it has not confirmed any retracement. The only thing the market does is what? Range. The market just range. But when the market moves further to the third step, which is the lower time frame break in market structure. Now, what I'm saying is, if this happens to be 1 hour, and you come down to 15 minutes, and you notice that we have a break in market structure in the 15 minutes, you want to understand that the market is going towards retrace based on the 15 minutes. In this form, we've now located our 15 minutes as the leading time frame. Now, there are two main time frames we'll be using for pullback, the main time frame and the leading time frame. The main time frame is the time frame that is actually controlling the general trend. Is the one controlling the general trend. The main time frame is the reason why the market is trending from a particular time frame. Why the leading time frame is the time frame where you want to know what is currently happening in the market. And in this case, the market is retracing, or the market is on the verge of retracing, and it is being led by the 15 minutes time frame. So automatically the 15 minutes time frame becomes our what? Our leading time frame. Now, when we have this lower time frame break in market structure and the market goes up, remember this 2 bar form the range, but not necessarily the retracement. What form the retracement is this ABC you are seeing here. A break in the market structure, you know, your ICT, everything, your break in the market structure, change in character, everything, depend on what you are using, Wyckoff, ICT, volume, SMC, whatever. But once you have seen your ABC pattern, and we have a break in the market structure, and the ABC has been confirmed, you want to automatically know that the trend has started. And that is why we have the number 4, the retracement trend. You want to automatically know that the trend has started. Now, what is this trend? The trend is being led by what? The 15 minutes time frame. So it is a 15 minutes time frame. A 15 minutes time frame. Retracement. This is not 1 hour. It is not 4 hours. It is not daily. It is 15 minutes. So you want to know that, okay, the 15 minutes time frame is the one leading this retracement. That is what you want to understand. The 15 minutes time frame is the one leading this retracement. And now, every retracement will surely have a target. Why? The target will always be a what? The target will always be the internal structure, the internal liquidity of the previous trend. So let's assume our target is around this point. Around this point. The market is going to retrace further into the what? Into the target region. And so when we've gotten number 5, retracement targets, the next thing is what? They are going to do what? They are going to change their hand, just like they did here to start this. They are going to form another ABC pattern. We have the break in market structure to give us A. We have the close below market structure to give us B. Then we have the pullback, a little pullback. Then we have the C to confirm the continuation of the trend. So this BMS is what you want to see in this 15 minutes time frame. Sorry, I made a mistake here. You want to see it in the 15 minutes time frame. You want to see the BMS in the 15 minutes time frame, which is the leading time frame. Which is the leading time frame. That is where you want to see the BMS, which is the leading time frame. So in a nutshell, 15 minutes time frame started the retracement. The market will keep on trending, following that rule. You know your rule of trend. Market goes up, retrace, break external liquidity, comes down to find a liquidity area in the internal structure, go back up, break external liquidity. It will keep on doing this. And when it does this, they will always follow what? Respect the market structure. They will always respect the market structure of. They will respect the market structure of the leading time frame, which is what? The 15 minutes time frame, in the sense that they will not close below the 15 minutes market structure if they don't want to reverse the trend. If they don't want to reverse the trend, they won't. They won't close below. So generally, this is how retracement works. And what happened when they get to the retracement target in the 15 minutes time frame or other block or higher time frame, other block in any region, what they do is what? They form the same ABC. You can see they form the same ABC to do what? To terminate this, to invalidate this. And that brings us to the first principle. The first principle is this. The leading time frame, which is the highest time frame with the ABC, will continue to lead the retracements. How will we lead the retracements? By obeying by obeying the market structure. By obeying the market structure, that is what it's going to do. It's going to obey the market structure until we have a reverse ABC from the same time frame. That is it. Until we have a reverse ABC from the same time frame. And I said, once the ABC is formed completely on the linear time frame, the retracement trend is formed. I said it before, and every other trend becomes an internal trend in line with the retracement. So this is the retracement principle. The leading time frame, which is the highest time frame with the ABC. Now, let me explain this. The highest time frame with the ABC does not necessarily mean that 1 hour daily or 4 hours is the highest time frame or monthly. No, it simply means that the particular time frame, the highest time frame as at that time that formed the ABC. That means that formed this particular pattern we are seeing here. ABC becomes your leading time frame. In a nutshell, if it is 1 hour that is the highest time frame, it becomes your leading time frame. If it is daily, it becomes your leading time frame. If it is weekly, it becomes your leading time frame as at that particular moment, that particular time. So this is it. Now, when we have the retracement target, which is the ABC, they change it, they invalidate it by what? Forming another ABC. And what? We have to what? We now have the what? The BMS in the leading time frame. And from there, we have this, the trend continuation, to go back to this what? To this external liquidity region. They will keep on following the market structure. We all know that. Break the external liquidity region, then keep dropping. So this is all about the retracement cycle. This is all about the retracement cycle. So what I was saying is the particular time frame, the leading time frame that have the highest ABC is the time frame that is going to invalidate this retracement, in the sense that whenever you have a retracement, an ABC from the lower time frame, ABC from the lower time frame, which is not the 5 minutes time frame, that is not. Let me clean everything now. I just want to explain this last part I'm talking about. All right, very quickly. Remember, we have our A, B, C, and the market move up. Now, if the 5 minutes form its own ABC, that does not mean that we are going to assume that the retracement is over. No, it is not over, because the main time frame, the leading time frame that formed this ABC is the 15 minutes time frame. So we want to see this ABC from what? The 15 minutes time frame only. It is only when 15 minutes time frame breaks it and the market breaks market structure, form the ABC, that is when the retracement becomes over. The retracement becomes over. Now, another scenario where the retracement is not over, even when the market breaks the leading time frame, is when we have a transition, like a transition of the leading time frame, in the sense that 15 minutes is no longer the leading time frame. It has what? Transcend into the 30 minutes time frame. 30 minutes is no longer transcend into the 1 hour. So that is the only situation whereby the 15 minutes time frame will no longer be the what? The leading time frame. But the transaction is not what we are talking about right now. We just want to understand how the pullback operates. So we want to understand how the pullback operates, and that is it. So remember the rules, remember the principles, remember what I just showed you. You can actually go back and back test and see for yourself. Now, let me just give us a chart example. Let me give us chart example. Let me give us a chart example, and we'll go. Now, this is what I'm saying. The leading time frame, which is the highest time frame with the ABC, will continue to lead the retracement. This is the principle. You have to know this. This is the principle. The leading time frame, which is the highest time frame with the ABC, will continue to lead the retracement by obeying the market structure until we have a reverse ABC from the same time frame. Now, let me just quickly show us an example from gold trade. If you look at this gold trade, we have this, the market trend up. We have our first leg. Yes, the market has done this. Now, we want to look for the retracements. Now, according to our retracement cycle. We have the what? The key level area. 1. The next thing is the what? Is the range formation. Now, what is the range formation? This particular bar 1 and bar 2 gives us the range formation. Now, we want to what? Highlight them. Those bar gave us the range formation. Now, after the range formation, the next thing is what? We want to go down to the lower time frame to check for what? A, B, C. Now, in this scenario, the range formation is from the one daily. So we want to go down to what? The lower time frame, which is what? We'll go down to 30 minutes because 30 minutes and 4 hours are what? Same. They work together. They are the sequence of time frame. Now, we want to look for our market structure break in what? In the 30 minutes. And now this is where we have it. This is it. We have our A around here. We have the A around here. From here, then we come down to the 4 hour to get the confirmation, the close. We have the close below it, and this is this particular bar. Close. Sorry, that's supposed to be B. Yeah, we have the B. Now, the next thing is what? The C region. We come down to the C region. This area is going to be my C region because of the opposition bar. There will be a range. Then the market breaks out from it. This is now the C region. Yeah. Now, this particular bar that breaks out from this range is now the C. Now, from this C, what do we have here? We now have what? Price doing our normal retracement drop. Then we have this up. Then we have this up. Now, from this is just the ABC. Then the market is going to do what? Continue trending, respecting what? The 30 minutes market structure region. Respecting the 30 minutes market structure region. Now, I made mention of a transaction. At this point, there is a transaction here at this point because the market did what? The market transcended into the higher time frame, which is the 1 hour. The next higher time frame, which is the 1 hour. So at that point, 30 minutes is no longer the leading time frame because of what? We now have a break in the what? 1 hour market structure region at the end of the day. And so this is it. We have a break of 1 hour market structure region at the end of this day. Are you seeing it? At the end of this day. So let me come back here and readjust this. Now, this is our A region. This is our B. Let me take this out. So our A region. Yeah. Now, this is our B. We have a close below. Now, this particular area becomes our B. Then we have the pullback to give us our C. We have the pullback to give us our C. Now, our C happens to be here, where we have a total close below the range. Our C happens to be here. Then the market did what? The market moved back up. Then we have the drop. Now, this is it. This is it. The first thing, the key level area. The second thing, the range. From the range, the third one is the what? The break in the lower time frame market structure. From the break of the lower time frame market structure, we have a what? A trend. And that is why the market dropped. We have a trend. Now, from the next thing, the next thing after the trend is what? We need to have what? The retracement what? Let me go back to the cycle. Good. The target. Now, the target is always the daily market structure, daily time frame market structure, internal liquidity region, or the moving average. I love using the moving averages. The moving average 21. I love using it. And that is why I made the call on my Twitter feed that gold is going to 2035, because as I did that day I looked at it, the market was actually, the moving average was actually at 2035. And that was why I said gold is coming down to 2035. And what happened? The market dropped down to 2035 because that is my retracement target. Now, from this particular point, I will now what? Wait and expect the market to form what? Another ABC pattern here, another ABC pattern here, like this, or anyhow, and from another ABC, that's our A, our B, We have the C. We have the market coming down to the inducements. We have inducements here, and market goes up. It can use any pattern, any model, any style. You know, they are all the same thing. ABC, as long as the ABC is confirmed. Now, in a nutshell, the principle is this. Since 1 hour time frame is the leading time frame, it will continue to lead the market until we have a reverse ABC that will take price back up. Now, let me look for a fully formed example. A fully formed example that we can go with from the daily time frame. Let's see this. A fully formed example that we can go with from the daily time frame. Should we make use of this? Yeah, this particular bar from the daily time frame. Now, this is it. The market formed our what? The range from the daily time frame. Now, this is the range. From here, is actually large, but we'll still use it. From here to this point, this was the range. That was the range. And in that range, we have a what? A break in the market structure. From 1 hour, we have our ABC formation to this point. This is our A and B. We have our A here. We have our B here. And what happened? The market confirmed it by giving us C at this point. C2 came in very quick. C at this point. Then we have the what? See, we have the retracement. The retracement back up after C, where there was an inducement here. Retracement, we went back to retrace. See, around this point, we have this move up, down, inducement, and the market went back up to this particular level, then drops. Now, this particular drop, the last drop you are seeing, is the trend of the retracement. It's actually the trend of the retracement. Now, if you are lucky to catch the swing from this top here, fine, because that simply means you entered from the lowest of the time frame. That means, so let's say from the 15 minutes time frame or the 5 minutes time frame, you're able to catch the top there. But looking at this particular chart, this particular range now, this particular level, this place you are seeing is the retracement trend. It is the retracement trend. It is where you want to catch your trades. And that's why Elliott waves traders will always say from wave 1, wave 2, sorry, wave 1, wave 2, and then wave 3 becomes the trend. Wave 3 is the real trend. So this is the retracement trend here, this particular one, after the ABC. Now, what happened? Let's see. Come back down to 1 hour. They got to the target. And what is the target? The daily time frame, moving average region. They haven't passed it. And what happened? They come back down to 1 hour to tell you that you don't need to actually put your pending limit or your stop or your sell limit or whatsoever, because you know that 1 hour time frame is the leading time frame. So we need to have a break in the 1 hour market structure for the market to do what? We need to have a break in the 1 hour market structure for the market to do what? So the market to continue back the trend from the main time frame, which is the bullish trend. So what do we have here? This is it. We have this. Market create a low, drop, give us our A here. Give us our A here. Oh, yes. Then we have what? At the end of the day, yes, this is our D. This happens to be our D. Then from there, what happened? We have the 4 hour range. This is our B level. We had the 4 hour range around this point to give us C, the breakout, C come around here. So please, I'm not actually talking about the ABC fully. I'm just showing us the retracement. So maybe from other time, I'll talk about the ABC. I'm just showing the retracement. So what happened? We have the what? The market comes back down, retrace after forming the C. Now remember I said after the range, look at it, it forms the range. This was the first range. It forms the first range, and automatically from the first range, it gave us our what? Our ABC, from our AB rather, and the next day gave us our C. So from the range to the break in market structure, which is the ABC, then towards the retracement trend, the retracement trend. Now we have our C, and what happened? The market continues the bullish movement. Look at it, continues the bullish movement, respecting what? 1 hour market structure. Say, price moves up, respect the 1 hour market structure here, break it here, but did not confirm it. I'm going to talk about that some other time, and went back up. We have another market structure region here, another one here. Market keep going back up until we have a what? A valid ABC close. I remember I talked about it the last time. So this is just it. This is just it. This is just how the market retrace. This is just how the market retrace. It's going to come the key level, range at that level, break market structure, then the retracement form. When I mean break market structure, I'm talking about the fully ABC pattern. Then the retracement will form. From the retracement trend, they get to the target, and when they get to the target, you apply the principle, and that is what? The leading time frame will continue to lead the retracement by obeying the market structure until we have a reverse ABC from the same time frame. Now, let me just show us alignment with what I'm saying so you understand. Let me align this together. Now, this is it. The leading time frame, which is the 1 hour, this is it, 1 hour, will continue to lead the retracement, obeying market structure. This is where it is. This bullish, bearish trend is obeying market structure. Are you seeing it? Until we have a what? A reverse ABC. So this is it. This is what you want to understand when it comes to pullback. This is what you want to understand when it comes to pullback. Another thing I will say is this: every system are all same. You just need to pick one, master it, then you are able to conquer the market. And whenever other people with their system comes to you, you'll be able to say something and even tell them what they are saying, because they are all the same thing, just different terminologies, different concept, and different ideology. So thank you. You can actually drop your questions. I'll be willing to answer them. Thank you.